Most people believe that a loan is approved or rejected for one main reason: income. If you earn enough, the answer should be yes. If you don't, the answer should be no. That belief feels logical, it feels fair, and it feels intuitive. It's also usually wrong. I've seen this from the inside again and again. People with stable jobs, solid salaries, and long work histories are rejected without a clear explanation. At the same time, others with lower income, fewer assets, or seemingly weaker finances are approved. When that happens, people assume something must be wrong. They think the bank made a mistake, or they think the system is arbitrary, or they think they are being judged personally. None of that is what's really going on. Banks don't start where people think they do. They don't begin with income. They don't begin with character, effort, or responsibility. They begin with fragility. From the bank's point of view, lending is not about how well things are going today. It is about how the situation behaves when things stop going well. That difference in perspective explains most rejections that feel confusing or unfair. When a bank looks at a loan application, it is not asking, "Can this person afford the loan right now?" It is asking something much quieter and much more important. How likely is it that this situation breaks under stress? Stress is not an abstract idea in banking. It is assumed. Loss of income is assumed. Unexpected expenses are assumed. Life-changing and uncomfortable ways is assumed. Banks are not pessimistic. They are structural thinkers. They do not plan for your best future. They plan for a weaker version of it. And this is where most misunderstandings begin. People approach loans with optimism. They look at their current income, their plans, their intentions, and their confidence. Banks look at pressure points, limits, and failure modes. What they are really measuring is something called risk capacity. Risk capacity is not about how much risk you are willing to take. That is risk tolerance, and it is largely psychological. Risk capacity is about how much pressure your financial structure can absorb before something breaks. It is mechanical, it is impersonal, and it does not care how confident or disciplined you feel. Two people can feel equally secure and look completely different to a bank. This is why so many rejections feel personal, even though they are not. Risk capacity is built from a small number of variables, and banks weight them far more heavily than people expect. The first is monthly pressure. People often focus on total debt. They talk about how much they owe in absolute terms. Banks care far less about that number. What matters is how heavy your monthly obligations are relative to your income. A person with high debt but low monthly payments may look calm under stress. A person with moderate debt but high fixed payments may look fragile. From the outside, both may appear responsible. From the inside, one has room to breathe and the other does not. Monthly pressure determines how quickly a situation deteriorates when income is disrupted. If there is little margin, even a small shock can create immediate problems. Banks are extremely sensitive to this because history has taught them to be. The second factor is stability over time. Now, this is where intuition often fails. Many people believe higher income always improves approval chances. In reality, stability often matters more than level. A slightly lower income that has remained consistent for years is easier for a bank to trust than a higher income that fluctuates or has recently changed. From a human perspective, change often signals progress. From a banking perspective, change introduces uncertainty. Income that depends on bonuses, commissions, variable hours, self-employment, or recent career shifts is harder to model under stress. That does not make it bad income, but it does make it less predictable. Banks prefer boring income, income that arrives the same way, at the same time, month after month. Predictability reduces fragility, and fragility is what banks are trained to avoid. The third factor is buffer. And this is the most misunderstood element of all. People tend to think of savings as something positive in any form. They assume more money used for down payments or debt reduction always improves their position. Banks make a sharper distinction. They care far more about liquidity than people expect. Liquidity is money that can absorb shocks. It is money that can be accessed quickly when something goes wrong. Savings meant for plans are nice. Savings meant for problems are critical. When someone uses all available cash to reduce debt or maximize a purchase, they often believe they are becoming safer. From the bank's perspective, They may be removing the very cushion that stabilizes the situation under stress. A low-debt household with no accessible cash can be more fragile than a slightly indebted household with a strong buffer. This runs against common advice, and it is one of the reasons people are often surprised by rejections. When these three elements are combined, monthly pressure, stability, and buffer, the bank forms a picture, not of who you are, but of how the structure behaves when pushed. That picture determines the decision far more than income alone. This is why two people with the same salary can receive completely different answers. One structure bends under stress, the other snaps. This is also why rejection often feels confusing and unfair. People say, "But I can afford it," and they may be absolutely right today. But the bank is not evaluating today. It is evaluating resilience. Once you understand that, many common mistakes come into focus. Applying immediately after a change in income or employment. Using every available unit of currency as a down payment. Maximizing loan size instead of building margin. These choices feel efficient. They feel responsible. They often reduce the very thing the system is looking for. There is one question that clarifies all of this. Before applying for a loan, ask yourself, slowly and honestly, if my income dropped for 6 months, would this still work? Not emotionally, not optimistically, structurally. If the answer is no, the bank will usually reach the same conclusion. This does not mean the system is perfect, and it does not mean every decision is fair, but it does mean the logic is consistent. Once you understand that logic, rejection stops feeling personal. And that understanding gives you something far more valuable than approval. It gives you control over the structure itself. Understanding the structure changes how you approach borrowing entirely. Instead of asking, "How much can I get?" the better question becomes, "How stable does this look under pressure?" That shift alone improves outcomes more than most tactical advice people receive. One of the biggest mistakes people make is treating the loan application as the beginning of the process. From the bank's perspective, it is the end. The real evaluation has already happened by the time you sit down, submit documents, or receive an answer. The numbers already describe a structure. The system is simply reading it. This is why explanations after a rejection often feel vague or unsatisfying. Frontline advisors rarely control the logic. They see the outcome, not the deeper mechanics. And so people leave with statements like, "It didn't quite fit," or "The overall picture wasn't strong enough." Those phrases feel evasive, but they are pointing to structure, not judgment. Once you see that, the next step is obvious. Change the structure, not the story. Trying to convince a bank with explanations, intentions, or assurances almost never works. The system does not evaluate narratives. It evaluates ratios, buffers, and time. This is also why waiting can be powerful. Time stabilizes income. Time rebuilds buffers. Time lowers pressure. A situation that looks fragile today can look calm 6 or 12 months later without any dramatic change in lifestyle. Most people underestimate how much patience improves risk capacity. Another overlooked factor is sequence. Many people rearrange their finances in the wrong order before applying. They reduce buffers first, then apply. They change jobs, then apply. They take on new obligations, then apply. Each of those actions may make sense individually. Together, they compress stability into a narrow window. From the bank's perspective, recent change equals uncertainty, even positive change. This is especially relevant later in life. As people move through their 40s, 50s, and 60s, financial decisions carry different weight. There is less time to recover from structural mistakes. Banks know this, even if they do not say it explicitly. This is not discrimination, it is mathematics. Shorter horizons reduce margin for error. That makes stability and buffer more important, not less. This is also why advice that worked earlier in life can fail later. Aggressive optimization, maximizing leverage, eliminating all liquidity to reduce debt. These strategies rely on time and flexibility. When those shrink, the same choices produce different outcomes. The bank's logic adapts faster than personal beliefs do. Another misunderstanding is the role of credit scores. People often assume a high score guarantees approval. In reality, credit scores act more like a gatekeeper than a decision maker. A weak score can block an application. A strong score does not override fragility. Once minimum thresholds are met, structure dominates. This explains why people with excellent credit histories can still be rejected. Their past behavior is not the problem. Their current configuration is. This is uncomfortable for many people because it removes morality from the equation. The system does not reward effort. It does not punish irresponsibility. It responds to stress profiles. Understanding that can feel cold at first, but it is also liberating. It means rejection is not a verdict on your competence, intelligence, or worth. It is feedback on a structure that can be adjusted. That adjustment rarely requires dramatic changes. Often it is about slowing down, reducing pressure slightly, leaving more room than feels necessary. One of the most counterintuitive truths in banking is that the strongest applications often look conservative. They do not maximize, they do not stretch, they leave space unused. From a human perspective, that can feel wasteful. From a structural perspective, it looks resilient. This is why people sometimes get approved for less than they expected, and why that outcome can actually protect them later. Banks are not trying to stop people from living well. They are trying to prevent situations that collapse under stress. When you align with that logic, outcomes improve naturally. There is also a psychological benefit to understanding this. People who frame borrowing as a structural decision experience less anxiety. They stop chasing approval and start designing stability. That shift changes behavior. They keep buffers even when it feels uncomfortable. They resist the urge to optimize everything. They choose boring over impressive. Over time, those choices compound, not into excitement, but into calm. And calm is what both banks and individuals ultimately value. If there is one takeaway from all of this, it is this. Loans are not awarded to confidence, they are awarded to resilience. Once you internalize that, the system becomes predictable. Not always fair, not always pleasant, but understandable. And when you understand the system, you stop fighting it emotionally. You start working with it structurally. That is the difference between feeling judged and feeling in control. And that difference matters far more than approval itself. If this helped you see the system more clearly, take a moment before your next financial decision. Calm structures outperform clever plans. In future videos, I'll break down how these systems really work, slowly, clearly, and without noise.